So, dear colleagues, dear friends, I think we have the quorum, and we can start our meditation. A number of us are used to this kind of discussion. A number of participants, and not only of speakers, have the memory of the previous discussion. So I think it's very not necessary for me to restate that we are looking at the economy and finance from various angles of vision. We have the privilege to gather personalities that are coming from, again, different origins, public and private, that are coming from different continents, that have the experience of dealing with IFIs or not, and all taken into account. I have asked them perhaps to concentrate their introductory remarks with a few major messages in order for all of us to have, I would say, the most interesting discussion after, because tradition is that we have short introductory remarks by the members of the panel, and then we engage in a very vivid discussion with participants asking questions, making remarks. So it must be as frank, direct, and open as possible in order for all of us to get the best out of this encounter. My intention, if it is agreed upon, is to ask John Lipsky to speak first, not in the alphabetic order, but because he would elaborate a little bit, taking into account his own position, experience on the diagnostic of the IFIs. We know the most recent diagnosis of the IMF since only a few half days. And we know also, of course, that the overall situation is marked by a very high degree of uncertainty. Uncertainty seems to me to be very much the rule of the game. To the extent that for each member, so normally I would give the floor to John, then to Yann Coatanlem, if he wants to speak, then to Dăianu, then to Jeff, if you agree, Jeff, then to Akinari, you are nodding, okay, then to Jean-Claude Meyer, and then to Nicolas Véron. You're not served by your name, but you're used to it. I will promise next time that you speak first. So now, for me to be in line with what I just said, let me only say a few words on precisely what are my main message at the present moment. I would say that even before the conflict in the Gulf, the global economy and finance situation was extremely fragile. And I think we should not forget that. Again, we have a number of indicators that are were not reassuring at all, in particular the overall debt outstanding, public debt outstanding in particular, in practically all countries in the world, which did not improve since the last dramatic great financial crisis. And that is certainly one of the indicators which is alarming. We have also had a continuing dramatic change in the structure of global finance, with the non-banks and non-regulated entity being more and more important and playing a decisive part. We are now at the level of 51%, if I'm not misled, in terms of, in comparison with the overall credit, bank and non-bank combined. So this is something which is very important, considered very important, of course, by the Financial Stability Board and by the international community as a whole, with a lot of attention given to this particular issue. And of course, this is part of the reason why we should be very alert again. I have also the sentiment, but we will discuss that at the level of the global finance also, we have a level of implicit bubbles that are not negligible. I was a little bit struck by the figure which was pronounced by Dominique Sénéquier on the global capitalization, where we have the US representing, if I'm not misled, around 70% of global capitalization, which seems a little bit too much, if I may, but I say that with great prudence, of course. But
the true number is around 50%.
The true number, I think it's more.
70% is the allocation of global portfolios, but it's not, I think.
I mean, again, we will not engage in a battle of figure, but it is clear that it's higher than was the case in the past. So that for one. I mean, second element, message from me, uncertainty in the present period is really the rule of the game. We were not expecting the war in the Middle East, but it is there. The impact, the global impact of this war looked until now to be very, very important, if not decisively dramatic at the global level. But this is, of course, a materialization of an uncertainty which is underlying the power politics which is marking the present geostrategic picture. Is of course an additional element of uncertainty, and I would say that in this universe, one of possible message would be resilience in this environment is the absolutely key for all entities in the world. Of course, the private sector, of course, the public sector, and certainly all those who have to take decisions in the present, I would say, circumstances. So resilience being the rule, augmented quite considerably because of the fundamental uncertainty that we are living in. And last point, to be a little bit more positive than I was until now, I would mention that despite all the divisions that we are observing at the global level, between countries, between continents, between the North and the South, and I am struck by the fact that the so-called BIS system, the Financial Stability Board, continue to work. There is no, I would say, absence of appropriate dialogue and discussions at that level of professionals, and the report is made by this so-called system to the G20, and despite also all the what is said on the G20 about to disappear, about to be replaced by other groupings, nevertheless, at least in the last years, even including the change in the administration of the United States of America, even taking into account again the extreme tensions between a large number of members of the G20, as well as the grouping which is more or less thinking that he might substitute or is complementing clearly the G20. But all that being said, we had the report given to the G20, and we had approval by the G20 of the essential element in that report. So an element of positive vision. Let's try to maintain the flame as long as possible in the present circumstances. But again, it had to be noted, and having been myself at the heart of this so-called system, BIS system, and the like, I think that it is all taken into account a little bit reassuring. Now, I will give the floor immediately to John. John, you have the floor.
Thank you very much, Jean-Claude, and you've made it easy for me since you've already highlighted the principal issues. But coming from the spring meetings of the IMF and World Bank, there were some clear themes that stood out, and I will highlight here. And I suspect none of them will come as great surprises to any of you. Certainly one of the surprises that was discussed but left, I think, unanswered was the source of the resilience of global growth in 2025. Certainly better outcomes than had been anticipated, especially in light of the Liberation Day shock to the trading system. And it was at first anticipated it would have substantial effects on economic performance and on corporate valuations. Remember the initial huge hit to US stock values. So surprise one was, why was it so resilient? And I don't think that there is a clear consensus explanation for that. Certainly US corporate profits held up much better than had been anticipated. And much speculation has been about that. One that perhaps of interest to report is from the view of the National Economic Counselor, the head of the National Economic Council, Kevin Hassett. His explanation, at least in part, is that actually we're seeing the productivity impacts of AI much more quickly than had been anticipated, and that it is being mismeasured, and it's showing up in corporate profits and productivity, but in fact, as he would put it, when we get the benchmark revisions to GDP, we're going to find out that US GDP was quite a bit higher than the current measures suggest. One possible explanation, of course, favorable to the Trump administration, but nonetheless, it is quite almost taken for granted that U.S. corporate profits held up much better than expected. And in looking forward, I suspect that is leads to another mystery, which is why have stock prices been so resilient in the face of the war and the laundry list, if you will, of risks that is perceived to the global economic outlook. But sticking to first the 2025 mystery, of course, the Chinese economy performed better than had been anticipated, as well as a result of a surge in exports that on the one hand had not been anticipated, but also led to the renewed concern over global imbalances, in which the Chinese surplus has now spread to other countries, even as the bilateral imbalance between China and the US has lessened. So today, I would say the focus is, as Jean-Claude mentioned, is on the risks to the outlook created by the war and the uncertainty about the duration and dimension and scope of the impacts. As Kristalina Georgieva explained, that in fact the new World Economic Outlook that they had planned to announce before the war in the Middle East was going to upgrade the global growth forecast, and without an increase in the perceived risk of inflation, and now that has changed. as is obvious to everyone. Both the outlook to growth has been marked down with the outstanding risks that it could be more damaged. The outlook to inflation has deteriorated and that it's expected to be higher. The perceived risk is especially reflected in concerns about energy importing emerging markets. That the risk is they will find both their terms of trade damaged, external demand for their exports damaged, and a need to find finance in a situation in which private finance may not be available. This, of course, all in the context of risks. At the same time, as Jean-Claude also mentioned, already concern is growing about the level of public debt and deficits that predated the war and only will be exacerbated by this. That's particularly true, of course, in a case like the United States, where by all intents and purposes, you can make an easy argument that the economy is at full employment. And despite that, we have a federal deficit that's going to be around 6% of GDP. Why that is good policy in this context is not clear. Another risk, of course, is represented by the disappointment at the latest ministerial meeting of the World Trade Organization and the risk of renewed trade frictions in the coming year as part of the risk obviously if energy prices remain strongly deviated from expectations. Similarly, for other commodity prices, the potential for new trade frictions is self-evident. Against that has been opportunities, and that the principal source of opportunities is artificial intelligence, of course, and the prospect that we've all talked about and thought about of how soon and how much it's going to cost, how soon it's going to pay off, or if it's going to pay off. And a quick observation, many have suggested this could be another dot-com boom. But as I like to put it, it has almost nothing to do with the dot-com boom, in the sense that dot-com involved, as I put it, a bunch of very smart young people sitting around offices in Mountain View, California, wearing polo shirts and khaki pants, who were convinced that their ideas were so wonderful that in just a couple of years they were going to be billionaires. And as I used to say, when the dot-com bubble burst, I wouldn't want to be the Ferrari dealer in Palo Alto, but I didn't think it was going to have a general impact because there was no capital involved. What's happened this time is there's huge amounts of capital involved, as we all can see. We don't know how big, but we know it's going to be. Already, estimates are it may have added as much as 1% of U.S. GDP in 2025. So real money is being raised. It's being invested in real assets, and the producers of the tools of AI, as we all know, are finding fabulous results and huge profitability, making sales to customers who have no profits and almost no income. This is all on the promise of payoffs. It's likely to be an important impact in financial markets going forward, but the uncertainty is going to continue. This is also linked, as Jean-Claude mentioned, uncertainty about developments in financial markets. One, the continued rapid growth of non-bank financial intermediaries, and perhaps most notable in the US, the growth in private credit, and worries that this could produce potential problems and instability, financial sector instability going forward. The consensus in Washington was that it's not big enough to represent a systemic threat. But of course, we've heard that before with subprimes. The claim is that the underlying complexity is much less than was the case in the financial crisis, in which the problem was, on the one hand, you had sophisticated products purchased by purchasers who didn't understand what they were or what was involved, and at the same time purchasing portfolio insurance, credit default swap against credit default swaps from an insurance company that had no capital. That resulted ultimately in a freezing of the interbank market. That was the real center of the problem. That doesn't seem to be a threat at this time, but there's still a substantial concern. Final remark. Listening to Ajay Banga, the president of the World Bank, the focus of the bank is on a limited number of sectors and a focus on job creation. And that seemed to highlight, I think, a generalized concern around in the global economy, that employment growth has been very slow in the advanced economies. And in the US in particular, there's a surprise of the low hire, low fire economy, in which either it's interpreted, can be interpreted as representing fragility, or something more to be expected in a context of an economy that's essentially at full employment and growing essentially at full capacity. So lots of uncertainty, some real promise, and continuing surprise, I say today, in the strength of equity markets, especially in the US, in the face of what are obvious risks. I'll stop there. Thanks, Jean-Claude.
Thank you very, very much indeed, John. Maybe you will think I'm too demanding on you, John, but one of us must report tomorrow. Would you be the rapporteur from now on? That's very, very kind.
What can I say? Ready.
So, thank you again, very, very much. My dear Yann, you have the floor.
Thank you very much, Mr. Chairman. It's always very sobering to speak after John. First of all, I want to clear something. What you see written on the board is not correct. I'm not the chair, obviously, of this session. It's clearly Jean-Claude, but I take the promotion. All right, let me go through some slides. Oops.
Here we are, yeah.
So I'll start with a picture that a lot of people alluded to earlier, which shows basically the size of the US economy again versus the EU, and specifically here it's trying to represent the capitalization of companies that are less than 50-year-old and that have more than $10 billion in market cap, right? And obviously you recognize immediately the Magnificent Seven, blue or green, Tesla could be added. And obviously the EU looks weak in comparison. So what I'd like to do is a sort of deep dive on innovation and in particular on R&D intensity and try to compare US, Europe and China in this race. And obviously, it's a big takeaway, and to me, that's really the first takeaway of the Draghi report, the huge lag between the US and the European Union. That's the first slide is sort of top-level differential of total R&D expenditure, and it's, well, you know, the US is 3.5% of GDP. That's much higher than the EU, and China is in the middle, as much as we can say. And you know, what measure you use, PPP or absolute level, is another question. But so here's the picture. Unfortunately, it gets worse than that. And this is taken straight away from the what's called the scoreboard of the European Commission that is published each year. So I think that was from end of last year for data all the way to 2024. I suspect as of now the gap is bigger, but if you just look at the first two lines, which is really tech in terms of software and hardware, you see the little blue of the EU versus the huge red portions of the US. It's quite staggering, right? So and China is kind of in between. Now let's try to decompose a bit further. I'm taking essentially 6 industrial sectors that have innovation and defense significance, since defense is such a hot topic right now. And if you look at enterprise R&D, so private sector R&D, what is really staggering is look at the total figure at the bottom line. There's a ratio between the US and Europe of more than 5, right? That's the R&D in high tech for, to simplify things, right? And China, as much as we can say, is kind of in between. For the EU and the US here, I'm using the official scoreboard. For China, I'm using the NBS, which is the local statistical agency, and we'll go back to that. But you know, staggering figure, and this is really at the core of the Draghi report. Right? Now, if you look at government-funded R&D, it's not too bad. You know, for these sectors, the EU is below the US, but the ratio is smaller. And then again, China is in the middle. I skip all that, you can refer to it later. Now, so China, as I said, is a bit tricky. If you look at the reason I used NBS as opposed to the official European scoreboard is that the European Commission seems to probably underestimate some of the Chinese numbers. Now, the question is, what do you call a private enterprise in China, right? You can debate that. Most likely the capital is government funded, but you know, there's enough freedom for these companies to compete on the national market and international market, so you can still call it a private sector. Now, so this is R&D. Now I just want to look a bit more at the quality of research out of China, and this is another very staggering figure that's coming from the ASPI technology tracker. ASPI is a big Australian think tank that produces this annual report. And again, we're going to introduce all kind of caveats, but it is rather staggering that China seems to be leading, you know, across all major technologies, and Europe is nowhere to be found here. That sort of breakdown for different sectors. I won't go too much into the details. And then I wanted to compare against the YPO, which is sort of UN official patent database. So there are differences, but overall, there's a lot of similarities between these two types of rankings. Now, on the quality of the research and the patents, there's been an interesting study that was done by Philippe Aguillon and his co-authors recently that shows that when the first Trump administration disincentivized researchers to co-publish with Chinese academics, suddenly the quality of the Chinese papers went down, so less citations in other academic publications. So you can see here the difference, the dark green versus the light green. China without U.S. co-authors, there are far less impact of the research. So the key date was 2018, and you can see a big drop of the quality of the papers once that policy was enacted by the Trump administration.
Can we go back?
Sure.
I have a difficulty to see exactly what is happening. Could you repeat what at which moment do you consider that in the first, if I understand, in the first term of the President of the U.S., we had this inflection point?
Right, so it's easier to say it here, actually. So around that inflection point was around 2018, right? So before that, Chinese academics were collaborating with their European or US co-authors, and you see an increase in the academic production in terms of citations until 2018. And from that point, especially spectacular in the US, obviously, that production went down, right?
Yeah, much more spectacular in the US than in China.
Than in Europe.
In Europe, I'm sorry.
Right,
yeah.
European
of course.
co-authors.
Of course. Okay, thank you.
So, I mean, all that sort of puts things in perspective and say, we can doubt some of the official stats about the quality of patents and the quality of academic production from China, but overall, there is a lot of investment, and Europe is already below that, right? So the competition for Europe is really from the US and from China. So finally, the last point, a slide I already showed yesterday, but what it means really for Europe, if we want to go back to the kind of level of R&D we see in US, but also in Switzerland and Denmark, is to really make restructuring costs of companies much cheaper. As you can see in Italy or Spain, where it is very difficult to restructure your ventures, there's almost zero investment in tech, right? So we have to do something about that. And I'll stop here.
Okay, thank you very much indeed, Yann. I think it was extraordinarily stimulating. I see a lot of us would like to have the slides.
Yes.
If it could be printed. And all of us could see the slides. Huh? Yeah, there was no particular problem to see the slides because, So thank you very much, Yann, indeed. And we have to meditate more on that. You were more or less confirming. You were confirming the present consensus. Jeff is signaling that it's difficult to see. Yeah. Okay, but in any case, we will ask the organizer to print the paper, and that would be very. And it seems to me that I can say that you are even, I would say, more impressive in pinpointing the, I would say, terrible, I would say, late position of Europe, even much more than Enrico Letta and Mario Draghi, if I may. So very, very telling. So, thank you again very much. Yeah, I will ask now Daniel if he wants.
I'm going to say, speak out what I believe is the global picture. I'm not going to use numbers, but I'll try to say, it may sound like platitudes, but this is how I believe. So I think what's happening in the world economy, fragmentation continues. Bretton Woods institutions are questioned or dismissed by some major players. And the transatlantic relationship is much crippled in a multipolar world. The European Union tries to save multilateralism. This is very clear. G7 and G20 still relevant but weakened, but still relevant. Large global imbalances are a threat. Financial instruments are increasingly used as weapons. Tariff sanctions, currency wars, crypto assets. There is a sort of a geopolitical financial warfare. Security considerations take precedence. It's a battle between resilience and efficiency. Defensive expenditure are up and quite rapidly. We should think about deficits and public debts in this regard. It's the old dilemma, guns versus bread. Artificial intelligence, I'm more cautious about artificial intelligence. You may say, Daniel, it's your nature. You're very pessimistic, but I think it poses huge risks apart from an existential threat.
Could you speak closer to the mic?
Yeah. Is it better now?
Yeah.
Okay. Secondly, global macroeconomic scene is worsening. I put it here, stagflation is looming. I may be pessimistic, but I think the IMF spring outlook is already outdated. Budget deficits will rise again at a time when fiscal space is very limited. It's already clear that we'll have a new inflationary bout. Supply chains are again strained, but I think central banks should be cautious in raising policy rates swiftly, as this is a supply side shock. What I'm very worried about is a new wave of financial deregulation. And it seems to me that lessons of the Great Recession crisis seem to have receded. Jamie Dimon talks about the new credit cycle, but he's very gentle and prudent. Credit conditions have loosened for years now, and banks are asking for loosening of capital and liquidity requirements. European banks, they always talk about American banks. It's the debate 20 years ago. We cannot compete with American banks, and there should be less regulation. As John has already mentioned, and you Chairman, non-bank financial institution share in funding has risen greatly, and the regulation of private credit is inadequate in my view. I believe that all types of finance need to be regulated because contagion can erupt from any corner of the financial system. The ECB sees private credit as a risk to financial stability. Louis de Guindos has one of the latest remarks. I think that central bank's independence is threatened, and it's not about the current American administration. I believe that in the background is the rise of authoritarian temptations in many countries, many economies. And there is fiscal dominance. And we know that in history sometimes some central banks have been forced to be more, give up on their major mission. However, I believe central banks may have to raise policy rates because of the inflationary bout. And also I believe that the effects of the Middle East war will persist. It's interesting to see how reforms will be implemented once the new chairman of the Fed is going to take his job. Now, crypto assets. Why I view crypto assets as a threat? The origin of crypto assets, I shouldn't get too much into detail, but it's the wish to decentralize finance, which in itself is a threat to central banks. Most of them are highly speculative. Stable coins in particular endanger monetary policy transmission and monetary sovereignty. Stable coins, and I think BIS is very much right, stable coins are not money and can harm the financial system as a whole. And they can trigger a crisis. The proliferation of stable coins is like we are getting back into a world of free banking, which is very dangerous. European banks should seem to be more relaxed about stable coins because they fear American competition. But competition is not necessarily good unless you have a regulation, a proper regulatory framework. I think that tokenization is the proper way to use new technologies. It's the BIS view, and I think the BIS view is fully justified. CFDCs are inevitable and will trigger a new type of currency competition. This is also an inexorable trend. About artificial intelligence, I'm coming to the end. Artificial intelligence can bring great benefits, but entails huge risks. A huge productivity shock, this is what Kevin Warsh said recently. I think it's an open issue, we'll see. Because it's not only the productivity, it's also about the social impact and political disarray. I mean, one should also look at externalities. It's not only an economic shock in itself. It can harm banks by revealing vulnerabilities. The Economist, I think, the latest issue of The Economist talked about the Mitos moment. And it can enhance contagion and invite a new financial crisis. And I believe artificial intelligence needs to be regulated. I'm not in eye to eye with those who say, "No, but you're going to stifle innovation." But it's hard for central banks, the BIS, Financial Stability Board, national regulators to coordinate closely. I mean, this is a big question. And last, for the euro,
please go.
For the euro to be a stronger reserve currency, the euro area needs EDIS, a safe asset, and more overall integration.
Yes, thank you very much indeed. I note that we have not only Kevin Warsh, but John Lipsky saying a moment ago that artificial intelligence might very well produce productivity progress of magnitude that we were perhaps underassessing until now. Anyway, thank you very much. I guess that most of the points you were mentioning will be discussed during the course of our workshop. I will now give the floor to Jeff, if he wishes.
Absolutely. Thank you very much, Jean-Claude. I feel very sorry for Nicolas, who comes last, because I had a whole series of notes, and I've been going through them as people spoke and checking off the points that were made. And there are no unchecked points on my list. So I thought I would talk about something different that I hadn't planned to talk about, but that I think is, in many ways, the lurking behind, beneath, above, around much of our conversations about the international economic order and about finance as well, which is geoeconomics, that is the use of economic tools, economic policies for geopolitical purposes. The core of geoeconomic policy is elasticities of substitution. Geoeconomic policies focus on those activities for which the supply is inelastic, right? The term that was used in some of the panels is indispensability. But when we think about this in a more rigorous economic sense, and that we now have some very rigorous studies of geoeconomics, this is all really about the inelasticity of substitution, whether of goods or of other activities. The problem with using geoeconomic policies on goods in trade for which supply is inelastic is that when supply is inelastic, the rents available to producers are enormous. So controlling the supply of goods for which supply is inelastic means forfeiting massive profits. And we've seen that with the lobbying by some of the firms that had their supplies, or that were threatened with an interruption of supply, which immediately say, if you keep us from selling to China, for example, we go bankrupt. So policymakers, perhaps unexpectedly and predictably, have turned away, in many instances, from using the most inelastically supplied goods for geoeconomic purposes. And that leaves, as much of the technical academic literature on this has suggested, financial tools for the use in geoeconomic policy. That has led senders and targets, potential senders, potential target. When we use the term sender to mean a country that is imposing financial restrictions for geoeconomic purposes, targets as the countries they're imposing them on, that has led for a search for financial vulnerabilities on the part of both senders and targets. In other words, countries that want to use financial instruments for geoeconomic purposes look for the vulnerabilities of their targets, and the targets look for their own vulnerabilities to try to block the possibility of using finance for this purpose. The obvious implication of this is very substantial, more or less continually increasing intervention in international capital flows. This is understandable. It is understandable that countries do not want to be subject to financial restrictions as they enter into greater and greater conflict with other countries around the world. It's understandable that countries that have geopolitical goals would rather use economic policies to achieve them rather than kinetic, that is, military means. But what is often ignored in discussions of this is, despite the benefits, these policies are costly. They're costly economically in particular. So the focus on the benefits of geoeconomic policies, I think, obscures many of the costs. There is an obvious cost to efficiency because it interferes with the allocation of capital both within countries and across countries. There is a cost because it leads to a lower level, or lesser degree of specialization in finance, as both targets and senders try to find general ways of adapting to financial intervention. It leads to a proliferation of innovation, and not the good kind of innovation, at least in my view, innovation in ways of protecting of countries and governments protecting themselves from financial geoeconomic policies and evading those financial geoeconomic policies. It also, in the case of both senders and targets, leads to decay of financial and more broadly economic reputation, because if you believe that the financial instruments in question are going to be subject to political intervention, you are less likely to give them the benefit of the doubt as to the credibility of the instruments themselves. And I've mentioned a couple of times on a previous panel and conversation, there is very substantial evidence at this point from very detailed academic studies that Treasury securities have suffered over the past year a loss of confidence among investors and monetary authorities around the world. More broadly, I think the general point that I would make is geoeconomics is here to stay. Geoeconomics has very important implications for international financial flows, for international finance, the international financial system more broadly, and for the international economy. And I would remind us that, as a political economist, politics trumps economics, geopolitics trumps politics, and that the where governments, as in the present world, have more and more recourse to the use of economic policies for geopolitical purposes, it is, I think, an open question as to how far this will go. In the past, it has gone very far, and the distance it has gone has been disastrous for the world economy, and for that matter, for international politics. But I do think it's important for those of us who are interested in international financial matters and international economic matters to think not only about the purely financial issues that have been discussed here and that all of which are checked off on my list, but to also think about the fact that we now live in a world in which geoeconomic policies are playing an increasingly important role in the development of international economics and of the international economic order and of the international financial system.
Thank you. Thank you very much indeed. I am struck by the fact that the vocabulary has changed dramatically, because what you said, maybe I'm making a dramatic misinterpretation, but we would call that in the past sanctions, financial sanctions, US financial sanctions, and yeah, I see you're nodding, so it's close to the concept that you were mentioning.
Absolutely. Financial sanctions are one of many geoeconomic policies. I mean, tariffs, export controls, financial capital controls more broadly. The term is generally used to mean any economic policy that's pursued for geopolitical purposes.
Okay.
And that's a pretty broad range, right?
Yeah.
You can go back, and it's not new either, because people keep forgetting that during the Cold War, we had massive controls on economic activity with the Soviet Union.
Of course.
And we know what that implied.
Of course. Yeah, John?
If I could ask a question. Having, like Jean-Claude, had some experience during the financial crisis, I think the idea at that time wasn't that countries forgot their individual interests, but clearly the dominant sense was if we don't hang together, we will surely hang separately. Is your perception that this growth of use of geoeconomic tools a reflection of great power conflict, the increasing great power conflict, or the other way around?
It is a reflection of increasing great power conflict. I think that if I were going to be optimistic, on the list that I discarded, I tried to end with something optimistic, and that's actually close to what Jean-Claude had said, which is why I didn't do it, saying that in extremis, the financial system, we just had Andrew Bailey at Columbia, and so I've known him for many years, and we talked about the FSB, and there is still dramatic levels of cooperation within the BIS and the FSB, as there was in the aftermath of the global financial crisis. So that's holding together, but that is a very technical, very limited range, and I have to ask myself how well that might continue to hold together if geopolitical or political or foreign policy conflict among the major powers, including the European powers and the United States, as on opposite sides of many issues, proliferates. At this point, I worry that the absolutely correct notion that if we don't stand together, we'll all hang separately, that may be gradually going by the board as governments focus more and more on competition among themselves than on the potential for cooperation.
Thank you very much indeed. Very, very stimulating. I would say that this is one of the modalities of power politics, which is the overall, I would say, characteristics of our time. Akinari, you have the floor.
Thank you. Two wars near Europe and AI have been already discussed, but let me frame the two things in a macroeconomic perspective. First, the wars. Let's imagine what standard economics textbook will tell us about this situation. On the supply side, the wars impose significant constraints on the production and delivery of energy materials, not only oil and natural gas, but also naphtha, ammonia, fertilizer, and therefore food. Heightened risks to such supplies have also raised the cost of risk management. I said this shifting practices from just-in-time to just-in-case several years back. But through a higher inventory and diversification of supply sources. That's costly. On the demand side, the wars are bringing with them higher defense outlays, both directly and indirectly, because national defense is no longer a notional issue, it's a real one. Therefore, it requires not only a stepped-up spending on armaments and weapons, but also heightened preparedness in terms of human resources, and also medical treatment and other supporting facilities. So, in the budget of many countries, some attempts may be made to cut other items in the budget, welfare spending, for example, but rampant populism will most likely check such attempts, and therefore fiscal largesse will likely expand. In short, the wars are generating massive increases in aggregate demand while constraining aggregate supply. Okay. Now let's go to AI. The AI revolution is accelerating. AI is entering every aspect of business and daily life of ours. All of us expected this to happen a year ago, but it has unfolded even faster than many anticipated. On the supply side, it's raising productivity so rapidly that some people are becoming anxious about massive job dislocations going forward. Some pundits argue that the resulting supply expansion will be so large that it could cause deflation in the global economy once again in the future. At present, however, the AI revolution is accompanied by a tremendous expansion in business investment in data centers, related facilities, which is driving up demand for semiconductors, capacitors, networking nodes, and of course electric power. As a result, prices of these items are rising, so are the stock prices of the companies that produce them. All in all, aggregate demand is growing faster than supply, at least for now, putting upward pressures on prices. Now, what will happen from here? Let us consider, of course, the future course depends crucially on how the wars develop. So let us consider a relatively optimistic scenario in which tensions around both Ukraine and the Middle East somehow abate. This is similar to the most recent IMF WEO's standard reference scenario. They changed the name baseline to reference anyway. So quite naturally, elevated demand and constrained supply will result in slower economic growth with higher inflation. And in this circumstance, savings will shift from glut to shortage. For example, most recent IMF WEO expects that the budget deficits of advanced countries to grow by 0.5 percentage point of GDP in 2026. Current accounts deficits of energy importing countries will increase, of course. Even in oil exporting countries, some sovereign wealth funds will draw down their financial investments to support reconstruction and replenish defense capabilities, as we heard from speaker from UAE yesterday. So, against this background, market interest rates will remain high or rise further, which could trigger repricing of financial assets across the board. So we discussed already, but some economists expect such repricing to be particularly salient in private credit markets and equity markets, discussed already, possibly leading up to a financial crisis. Well, despite these concerns, however, the market appears less cautious, or I should say more sanguine about the world economy, judging from stock and bond prices, as well as risk indicators such as CDS premia. For example, S&P 500 fell only 8% from its previous peak during the Iran war before it more than fully rebounded. This episode contrasts with a 25% drop immediately after Mr. Trump announced his Liberation Day. So that's quite a different market indication. There is a gap between the majority view of economists and what the markets indicate. The market is obviously more optimistic than economists, like Daniel said a moment ago. WTI futures, I checked, show a steep backwardation, with July delivery in the high $80 per barrel, and December delivery in the mid-70s, $70. So the market expects the condition will return to normal before too long, or at least by the end of the year. Economists at the IMF and elsewhere, on the other hand, appear to take supply disruptions more seriously. I have always thought the market is risk neutral, while most economists tend to be cautious. Of course, economics is often termed as, dismal science, and economists are paid to worry about many things. That's quite a nature, but the contrast now is more striking than usual. This is what we are seeing. The market's present optimism stems largely from its expectation that the AI revolution will outweigh the negative effects of the war. In economics terms, the aggregate demand elevated by the wars and AI will be met by enhanced productivity gains and supply increases. I hope this will eventually prove true, but the market seems to discount this element over a much shorter horizon than economists do. So, which will prove correct, the average economist or the market? Over the past several years, myself tended to be optimist, you remember, about the global economy, particularly the US economy, while many economists became pessimistic after Mr. Trump was elected US president. My optimism has been based on two elements. One is AI, which we discussed already. The other is the fact that there is little over-leverage in the private sector of advanced economies. There may be hidden leverage, but hard to detect yet. On the flip side, the public sector is heavily indebted, as Jean-Claude Trichet mentioned. Of course, this is a problem. But if economic growth continues uninterrupted, coupled with productivity gains from AI, like the market expects, we may be able to correct budget deficits through taxation or tax increases or automatic tax increases. At the moment, the presence of large excesses in the private sector, particularly in the core parts of our financial systems, in short, banks, is an encouraging fact that support optimism about continued economic growth with somewhat elevated inflation. So I have lots of things to say about stable coins, but let me stop here for the moment.
Excellent. Thank you very much indeed. We will have a full-fledged discussion on the stable coin and the like. But thank you very much. I see that you are more on the optimistic side.
On the market side, yes.
And you were not always on this side. Now, Jean-Claude, could you elaborate a little bit on your own view?
I will be more on the pessimistic side. The United States are in a cul-de-sac, and the world is in deep trouble as we don't know when the Strait of Hormuz is going to reopen, soon or not soon. And we all know that the world depends on its issue from an economic and financial viewpoint. It is very presumptuous to make any forecast now, because we are in the dark night. Therefore, just a few comments. First one, there has been last year two pivots. One in favor of European and Japanese stocks versus Wall Street, particularly because European PR were 18 versus an expensive 28 for the S&P 500, and another pivot in favor of the euro versus the dollar, minus 9%. But this year we can expect two reverse pivots. One in favor of Wall Street versus Euro stock, as American companies are expecting earnings growth by 18%, much higher than in Europe, by 10%. Europe is hit by energy prices, whereas the US are, as we all know, net exporters. Growth in Europe will be this year around 0.9% compared to a US growth anticipated at 2.7%, and an increased rates in Europe versus no cut by the Fed should deteriorate further the European stock markets. Besides another reverse pivot, the dollar has already gone up and shouldn't continue to do so except if there is a cut from the Fed this year. Indeed, as US stocks, Amazon, for instance, has gained 3.5% yesterday, and US treasuries will continue to attract hot money, and as increased energy prices will need more dollars. For every 10% increase in energy prices, the euro slides by 0.8% because of higher demand of dollars. Second point, the crisis will affect more Europe than the US and will lead to different monetary policies. Although both will have to face a dilemma between a rise of inflation and a growth risk leading to stagflation in a vicious circle, with a hawkish shift towards rates increase instead of cuts. In Europe first, we expect limited growth, below 1%, and an inflation of 3 to 4%. As a consequence, we might have 2 or 3 rates increase this year. In the US, with interest of 3.5 to 3.75%, with an employment of 4.3%, a sticky inflation of 3%, although not that much contaminated by the tariff tax increase, and with a growth of around 3%, the Fed could be on a wait-and-see position even after the departure of Jay Powell mid-May, and avoid the cuts advocated by President Trump. And on the contrary, an increase of the rates because of inflation once this year is not impossible if inflation deteriorates. The last Federal Open Market Committee of the Fed was already split between 7 members in favor of no cut and 7 members of just one cut of 25 basis points. But a monetary policy in order to fight against a shortage of supply, which is now the case, is not a good medicine, while it is efficient to fight against an excess of demand. And it will increase the cost of refinancing heavy debts, becoming worrying because of investments in defense and damaging emerging countries. Third point, there has been still now a splendid paradox. We are confronted by huge risks still in front of us, but the stock markets may be stupid, have oddly enough not declined much, not more by 10% since early March, except in some particular sectors such as the luxury, and they, moreover, since the beginning of April, S&P and the Euro stocks have regained, thanks to good expectations on first quarter earnings. And AI stocks are booming, in a bubble maybe, and tech stocks as well, plus 15% this month. But we're not sure that this paradox will last for long. Fourth point, indeed today we can dream of a ceasefire, but a ceasefire will be maintained during a certain period of time between Israel and Lebanon, that the Strait of Hormuz will reopen soon, and that negotiations between Iran and the US would succeed to a certain extent, so that US Army does not stay longer in this region and in order to prepare midterm elections. But even if this dream becomes true, financial markets will be volatile because of the risk of stagflation. The price of energy should continue to remain high this year because of the destruction of some key LNG infrastructures in Qatar. 17% are destroyed. And in Kuwait, a lot in Kuwait, reducing energy output, which could keep the barrel around $100 for months and damage some key economic sectors, such as chemicals, of course, but also fertilizers because of sulfur, the food industry, therefore, aluminium, semiconductors, automotive industry, while fueling inflation, raising interest rates, reducing consumption and growth, and affecting the stock markets. On top of all, we are confronted for a certain period of time with a huge uncertainty, as Jean-Claude has mentioned, particularly in the Gulf, whereas it has been such a sunny paradise for years, as it will take anyway time to a complete reopening. It will remain, unfortunately, risky and unstable and undermine confidence. To conclude, we are probably going to live in a very dangerous way and uncertainty in the coming years, and we should remain extremely cautious. Even if peace happens shortly in this region, stagflation at least will appear, and as a paraphrase from President Hoover, the crisis is at the corner of the street, with the hope that I am completely wrong, if a strong peace hopefully arrives very quickly.
Thank you very much indeed, Jean-Claude. We all hope that you are totally wrong.
Yes, me too.
Because without saying, you too, I understand. Can I turn to Nicolas?
Thank you.
Nicolas has two hemispheres in his brain. One is a US hemisphere, the other one is a European hemisphere. The senior fellow of both best think tanks on both sides of the Atlantic. We are, suspended to your lips, my dear.
Jean-Claude, of course, is alluding to the fact that I work both for Bruegel, which is in Brussels, and for the Peterson Institute for International Economics, which is in Washington, D.C. And I have to mention that the honorary chairman of Bruegel is Jean-Claude. So thank you, chairman. I did, some of you may have attended the panel in which I spoke yesterday. So I did give a little bit of EU versus US during that panel. I'm not going to repeat exactly what I said yesterday. Rather, I will look at the global financial system a bit holistically. And I will, since the mood so far has been a kind of balancing of optimism and pessimism, I will start optimistic and end with a little bit more of a downbeat tone. So I will start with resilience and continue with risk and end with a question mark. Let me talk first about resilience, and I think we all want to have a conversation now, so I'll be a little bit too succinct, I guess, very cartoonish, and then I hope we can come back to some of those points in the collective discussion. The market, of course, has been incredibly resilient given the magnitude of the shocks of the last 18 months, particularly, I would say, the doubts about US institutions. Some of us were having that conversation at lunch. I would make the argument that the political regime in the US has changed. So we have experienced regime change in the US last year. And my point here is just that the core of the US political regime is the US Constitution, and the US Constitution is not being enforced. So we have the Supreme Court, blowing hot and cold, but letting the executive branch do a lot of things that are clearly contrary to the Constitution, And perhaps more importantly, we have Congress not playing its role of being the main check on the executive branch under the US Constitution. And in that context, it is remarkable how serene, how even upbeat the financial markets have been. Actually, I did check the evolution of German stocks between early 1933 and 5 years later in 38. They went up 50%, so maybe we should not have anticipated a negative reaction of the stock market to this political regime change. Now, I'm not saying that the US now is Germany in the 30s, not at all. That's not my point. And I have no intuition, and certainly even less conviction, on where the US will go politically. I suspect it may not come back to where it was 18 months ago, but that doesn't mean the most horrible scenarios will materialize. So I think this is just a point about market resilience as opposed to US politics. The second thing that has been remarkably resilient in that context, and this is much more structural than market fluctuations, is the international central role of the dollar. There were some wobbles in April for a brief period, April last year, a year ago. But at this point, basically, and I speak under Jeff's control here, the central role of the dollar in the global financial system has not changed. Of course, we don't know the exact numbers of reserve currencies and so on in real time, but basically, from a kind of basic smell test, there's probably some diversification of going on in central bank reserves, global investment portfolios, but nothing dramatic and nothing of a completely different nature from the kind of fluctuations we've seen in recent years and decades, the kind of things that Barry Eichengreen, among others, has documented in terms of diversification. Anyway, no sea change. Even more structural, and here I will repeat actually what you said, Jean-Claude, in your introductory remarks, we have seen the, unraveling of some global institutions, the US exiting a number of UN agencies, the WTO, of course, being stuck in a stalemate, and we had a lot of discussion of that already at this conference. The IFIs, IMF, World Bank, in a slightly better place, but still very, defensive, let's put it that way. The World Bank no longer talks about climate change, that kind of thing, which is a big change. The IMF is enthusiastic about Argentina, I mean, that kind of thing. We haven't seen that in the Basel cluster, as you said. Part of that is because the US is actually not a dominant stakeholder in the BIS, but part of that is probably the very nature of the BIS, which is an organization of central banks, not an organization of governments. And the Fed, of course, I could have mentioned it in the resilience, so far has been relatively unaffected by the turmoil, even though, of course, it may be changing soon. But I think it's remarkable that even if you look at the way these things work on a daily basis, the implementation of Basel III, let me remind our European participants here that on the basis of the proposals issued last month by the Fed and other agencies, the US will be more compliant with Basel III than the European Union, probably, when all the dust settles. We'll have an assessment by under the Basel Committee's Regulatory Consistency Assessment Program, which is a very good program, in 2029, so we'll have to wait a little bit to have confirmation, but my expectation at this point is that based on previous episodes, the EU will be found non-compliant or materially non-compliant, and the US will be found probably largely compliant, as it was in the previous round. So it is not the case that the US is exiting Basel while the EU is staying in Basel. It's a much more nuanced picture in which compliance with the Basel framework in the US remains quite good, even though they have deregulated and they have basically eliminated a lot of gold plating that they had above Basel under the Trump administration already. So, lots of resilience. Now, also lots of risk. I completely agree with Daniel. The kind of swing of the pendulum in terms of regulation and supervision is absolutely striking. Those of us who have been through the previous cycle and who remember the time before the great financial crisis are horrified, because we see the same vibes as we had in the mid-2000s. We know where that led, and we feel that it will lead to the same place again. And that applies to the US. I mentioned yesterday the US cycle of deregulation, desupervision, and institutional erosion. I'm not going to repeat. But it also is visible elsewhere. For example, the UK, with the idea that the Bank of England has a growth or competitiveness mandate, whatever, is sending a very alarming signal, even though the Bank of England says nothing has changed, and they have also lowered capital requirements, not in a very big way, but with, again, sending exactly the wrong signal. And in the EU itself, so far, policy has held the ground, but the lobbying of the banking sector is relentless and very determined, and frankly, they're getting political traction. The banks, of course, have extraordinary access to the political leaders, and at this point, the technocrats, central bankers, financial stability people, bureaucrats in the European Commission are playing a very defensive game against the pressure of the banking sector to decrease capital requirements. We will probably have an indication later this year on how that's likely to play out ultimately, but it doesn't look very promising. So if you believe in that theory of the swing of the pendulum, we are going into a cycle of deregulation that's going to result in a major financial crisis somewhere down that road, and that's completely depressing. Now, my final note, which I have said is a bit downbeat.
That was optimistic.
Yes. There's a short story of Isaac Asimov called Nightfall. Maybe some of you remember it. Asimov, which of course was a genius of science fiction and many other things, viewed it as his best piece ever. So much so that he later made it into a novel. I think the short story is better than the novel. It's much more crisp. Anyway, Nightfall tells the story of a planet system somewhere out there in the space where people basically keep repeating the same catastrophes over and over again because of the way the planets interact with each other. It's very funny. Essentially, every couple of thousand years, they destroy civilizations and they rebuild it and then they destroy it again. It's super crisp. Read it, it's very short. So I've always been thinking about that short story when thinking about the swing of the pendulum, because it's kind of the same thing, right? I mean, you rebuild and then you forget, and some alignment of the planets make you destroy everything, and then you rebuild again. Now, Nightfall was written, the original short story, in early 1941, and the downbeat tone is whether actually this kind of thing is to be thought about in terms of financial stability or more basic, security stability. And it's hard not to think at this point that it might be the latter, and that actually, a financial crisis is the least of our concerns, because the security crisis that may be coming could be larger. Maybe that's not the right way to think about it, and I actually hope it's not. Thank you.
Thank you very much indeed. I was reflecting on what you said in the pendulum. Without having a full-fledged pendulum as we have observed in the past, and you said that very clearly, I'm always struck by the difference of perception between the both sides of the Atlantic, not to speak of other continents. We have the US always telling us, and from their standpoint very rightly so, don't over-regulate in advance, it's stupid. Let the market make its own explorations. You will see, maybe we will have marvels. If on top of the marvels we have risks that are materializing, okay, we will make it, we will invent what is necessary to combat the risks that are materializing. And you, European, you're much too concentrating on regulation and preventing in advance a lot of bad consequences that perhaps could come, but perhaps could not come. And therefore you are hampering the discovery of the new technologies, prowesses. And again, with AI, we have clearly these two visions on both sides of the Atlantic, and that it's clear that we need both. If I may. We should not be too European in preventing in advance a lot of discoveries in the technical side, in particular, that are, or in the financial side, or whatever, in the economic side, that are of extreme importance. And the US, of course, should know in advance that they are taking a lot of risks. And when there is a catastrophe, the catastrophe is not only for the US, but for the rest of the world too, as we could observe, unfortunately, at the moment of the last great financial crisis. Anyway, I think the tour de table was very stimulating, and we should concentrate maybe on some important point. I would list perhaps the two first ones, if we accept to speak very, very concisely, because we will have to close the session at 6:45 or something like that. So, or maybe at 7. 7 we could make it at 7. So the first one would be perhaps how you would discuss the AI productivity progress themselves. How do you feel that this economically and theoretically should be assessed? I think we are still in a very uncertain world. I'm not myself convinced at the stage. My optimistic reaction is it will produce fantastic results, because all such innovation that were of that magnitude are likely to be benefiting the overall economies and of course our fellow citizens. But again, this has to be perhaps explored a little bit, and I think it would be good. As was mentioned previously, we have the issue of the stable bonds and of all the tokens and all what goes with it, which is also underlying. And maybe we could also have an exchange if, again, we are sufficiently concise on this element also. And maybe we could conclude, Jean-Claude, with the likelihood of a big difficulty in the financial sector, which is also, of course, something which we cannot avoid to discuss a little bit. Now, I open for full-fledged discussion. No long exposition, but remarks, tough remarks, speaking our minds, speaking our guts in some domain. And I start with AI. I see, Yann, you're ready. Please.
Yeah, no, I was going to react to what Akinari said earlier. When I looked myself at the beginning of the year, which was almost a century ago when you measure in AI terms, but I look at specific models, one coming from Wharton University, one from Goldman Sachs, one from EY, and then sort of more casual discussion with people like Aguillon and sort of more back-of-the-envelope models, if you will. The maximum I could see in terms of projections over the next 10 years would be something like 0.3% per year. So 3% over 10 years max, right? And maybe Aguillon was a bit more generous, and again, maybe it was sort of more back of the envelope. But I didn't see any large impact predicted yet, right? So I think people are very cautious, and I think nobody knows, frankly, how far it can go.
Well, this is a good start.
Just one comment. It's already obvious that many computer programmers are being laid off. They are no longer used. I mean, AI program everything, you know. So that's already done. And the consulting companies are getting into trouble because those companies used to design systems for financial institutions and others. Now, banks use AI, and produce programs in-house easily.
Right.
That's obvious.
But I think you see progress in maybe 10% of the economy, and then you have massive size of other sectors that are not impacted by AI. So net, you see these relatively modest expectations.
Well, I said...
I'm sorry. No. Oh, sorry. John, you mentioned that there was a surprise in the productivity progress, and you were very close to attributing this productivity progress to AI. Did you?
I ascribed it to Kevin Hassett, is the administration's claim. But I guess a couple quick comments. My line is, in the industrial age, machines made weak people strong, and in the information age, technology makes stupid people smart. And first of all, I don't know why that is bad for inequality. That creates inequality. It seems that it holds out the prospect. What's that?
Because rich people are stupid.
No, that it ought to create productivity gains, not just in computer software, but in other areas. But it makes, in general, makes workers more productive. And as we've also seen, that as a student of Paul David, who was the original theorist of technology diffusion, or perhaps the most prominent, that it takes time, but that productivity gains never move, deriving from technology, never move in a straight line or a smooth line, but in waves. And the second reference I like to make is listening to Jensen Huang of NVIDIA, who told us at Stanford last year, in 10 years, computers will be 1 million times more powerful than today. Computers will be very expensive, but computing power will be nearly free. So he said, think of a future in which you can have access to all the computer power you can imagine, virtually for free. What will that mean? And the answer is, none of us have a very clear idea at all. And therefore, to try to surmise what's going to happen is difficult.
Yeah.
It's better not to get crazed, but still, it's also probably an error to be too cautious.
Good. Before giving the floor to Jeff, one remark, because what we are discussing looks very much like the Solo paradox, with the new computer, the mainframe. Solo said, I'm very surprised because I see a lot of spendings in the fantastic mainframe, and I don't see any consequence in the productivity progress that we measure. And it lasts a long time, when at a time, then you could see that there was no more paradox because there were productivity progress which were very impressive. So are we more or less in the same sequence in your mind? But I'm sorry, don't respond immediately. The question.
No, I think that's a great entree. I mean, Solo said we see computers everywhere except in the productivity statistics, and we see AI everywhere except in the productivity statistics. I think I was going to make one minor point and then a broader one. The minor point is the people that some people I respect, say that most of the influence that we see of AI on growth now is in traditional industries building data centers. Yeah. So cement actually is booming because you need a lot of cement to build a data center. So it's not AI itself that's leading to this growth, it's the production of that leads me to a broader point, really from economic history, because we can't predict the future. I mean, at least I can't predict the future, but we can use some of the experiences of the past to try to think of what patterns there may be. AI is a general purpose technology, and the general experience with general purpose technologies is that the productivity increases are not in the technology itself, but in its use. So when steam power, the railroad, electricity, the internet came on stream, the first indication, the first tendency was to say people are going to make a fortune in railroads or electricity or the internet. But everybody piles in, it's highly competitive, and eventually all the rents get competed away. And everybody that starts a railroad goes bankrupt. And no one wants to be an internet service provider today. And it's very easy to produce electricity. Now, it's hard to see all of the AI companies going bankrupt or losing the rents that they're currently earning, but there's a lot of competition in that space. So I think that what we are likely to see is a process of discovery of what industries can best use AI to improve their productivity. And there already are studies trying to figure that out, but they're speculative. And so I would say don't expect AI itself to be the productivity, the engine of productivity, but its use to be the engine of productivity. And so that means the money probably in the longer run will not be made in AI itself, but in industries that figure out how to use it. That's a lesson from now. Maybe the future will not be like the past, but that is the lesson of economic history with general purpose technologies.
Okay. John, and then Nicolas, if you wish.
The only comment I was going to make is Paul David's seminal Computer and Dynamo article was essentially written in response to Solo's remarks, the suggested being that at that time our understanding of the process of technology diffusion and its effect on productivity was very poorly understood. Much better now.
Thank you. Nicolas, you asked for the floor.
Yes, absolutely. John reminded me of this famous prediction by the chairman of the US Atomic Energy Commission in 1954, and it's so good that it deserves to be read again. It is not too much to expect that our children, this was when commercial nuclear power was starting to be a thing. It's not too much to expect that our children will enjoy in their homes electrical energy too cheap to meter. Well, know of great periodic regional famines in the world only as matters of history, will travel effortlessly over the seas and under them and through the air with a minimum of danger and at great speed. Okay, so that kind of materialized. And we'll experience a lifetime span far longer than ours as disease yields and the man comes to understand what causes him to age. I mean, some of this has happened. It's not bad. But electricity too cheap to meter? No, hasn't happened. So I think AI, to me, is kind of the same thing. We can extrapolate some of the wonderful things that are being projected, but maybe not all of them.
Thank you. Thank you again. I have to repeat, of course, that all of us can intervene, make comments, ask questions. We are a full-fledged now working party where we are all equal. So, who wants to say a last word, perhaps, or a new idea, launch a new idea, please?
So you're obliged to speak in English.
Yes.
I wanted to start by citing what somebody talked about, this solo prediction, or saying that you have productivity everywhere, but not in the statistics from the computers. The same for the AI. In fact, I think we have to distinguish between the sectors that produce AI and the sectors that just consume AI products. So this is one thing. I don't know the study you mentioned from Harvard University did this distinction. Secondly, when you invest in infrastructure, there was a study from OECD telling that if you invest $1, you have to invest $9 in human capital, in reurbanization. So I think we need all this deepness if you want to estimate the impact of AI on the economy.
Thank you. Yeah, please.
Yeah, just to clarify, these studies were the full impact on GDP, so across all sectors. Now, how accurate, precise the assumptions were, I don't know. What was striking, though, is everybody was making had the same kind of predictions, same order of magnitude. So maybe everybody was making the same mistake. I don't know. But yeah, it was really a global impact, not just in AI.
If I understand well, not to miss your point, Yann, you said that after due meditation with Nobel Prize and so forth, you arrive at more 3% growth more
over 10 years.
Over 10 years in the US. Is it in the US?
Actually, you know what? I forgot where it was.
3% is good to take in any case.
Let's assume the US, because again, it was Goldman Sachs, EY, and Wharton University. But,
okay.
Yeah.
Okay. Thank you. So, pardon me? Yeah, please.
Yeah, in general, in macroeconomic terms, 3% is not 3%, but 3% of what exists already. So we have to make also this distinction. 3% of maybe the 2% we have today. So it will be 2.06. It's not.
No, what do you mean? Just 0.3% of growth, annual growth, right? That you add to your usual projection. So as we said, 2.7 or what it is for the US this year, right?
Okay. So Daniel, and then wait a little. Daniel, please. What is it?
It's about the impact, the overall impact. It's many people accept as a working hypothesis that it's going to increase concentration, market concentration. And this is not good. Clearly, it's not good. Secondly, it's going to increase inequalities. In the realm of finance, it may enhance herd effects and increase contagion. So a big issue is for the regulator. What are we going to do against the background of the regulation? What's going to happen? I think, and then last but not externalities. If you have a lot of replacement and displacement, you end up with a big social problem.
Yeah, thank you. You're on the negative side, of course, and they are negative associated with any new, I would say, innovation, major innovation. Even in the last ancient time, the Greek philosophers were analyzing very clearly all the drawbacks of poetry. Poetry was not that good necessarily because it permitted certainly to memorize a lot of sentences, and the writings also were not that good. I mean, each fantastic invention, and I take it as a fantastic discovery of I would say our own civilization, has a lot of drawbacks clearly, and we have to care for the drawbacks. But perhaps just in between the US and Europe, not I would say being too cautious and not permitting the I would say benefits to flourish. You have the floor, sir.
Thank you very much. I just wanted to rebound on 2 points that were mentioned by the panel. The first one was that European countries have too much debt and very limited fiscal space. The second point that was very impressive is this huge difference in terms of tech size between Europe and the US, and the fact that Europe is really lagging behind the US in a huge order of magnitude, and that my belief is that AI will accelerate this gap because the US are going much faster in AI than Europe. So how do we address this situation where basically in Europe we don't have any financial flexibility, and this decoupling of the economies between Europe and the US are creating a very strong factor of instability. So I was sensitive, for example, to the point of Yann about saying that we can improve labor flexibility and that will increase tech investment in Europe. Okay, but my feeling is that the only way to change the situation would significantly change the capital supply in Europe on tech. And my question for the panel is, how do we do that? I mean, how do we, if we have no debt flexibility, how do we invest in a major way in tech in Europe to try to merge this gap?
Before letting Yann respond to you, two remarks. One is the US has no more fiscal space than us. To be frank, much less, obviously, in many respects. And on the other hand, the Europeans have a savings surplus, which is very solid, if I may. They don't make the best use of it, but they have this surplus, which is not the case, if I'm not misled, in the US. So we should not underestimate our own potential, if I may. We make a very poor use of this potential at the present moment. And my own understanding of the lag between both sides of the Atlantic is that, frankly speaking, we do not have yet a single market. We discussed that today. We have no working single market. Why? Perhaps because we have a glass ceiling, which is the fact that we are not a full-fledged federation, political federation. The US is a political federation, and there is no division by states in the US, when it is absolutely obvious in our case. And of course, Letta and Draghi are telling us what to do to create the real single market. Well, I'm a little bit afraid. We were going in this direction as rapidly as possible, but I'm a little bit afraid that the glass ceiling would continue to be there. But that's another story. Yann.
Yeah, no, I mean, a single market would certainly help, but, in this world of open capital and large capital flows, when you talk to sovereign funds, for instance, they'll tell you that, they are overly invested in the US and they would love to diversify for obvious reasons, right? Sovereign funds in the Middle East, even European companies end up investing a lot in the US when you could argue, I mean, they could easily invest at home. And, you just need to make sure that the returns of your venture is high enough, and that's the key thing, right? I mean, the private sector is much more profitable in the US than it is in Europe. As simple as that. So that in itself. Sorry, John?
I'm sorry, Jeff, and then John.
I was just going to make the point in response to the comment that was made, that we've talked a lot, it's been mentioned, the global macroeconomic imbalances have been mentioned. One of the big imbalances is surpluses from Europe, that is the surplus savings that have largely been invested in the US.
Yeah.
Now, and so it seems to me, just following, and this is just to agree with Yann, that there is no shortage of savings in Europe. There's a shortage of investment opportunities that are more attractive than those in the US. And I think the goal for Europe should be to try to turn that around.
Sure.
But isn't part of the difference the ability of innovators to obtain financing in the US? In other words, isn't a lot of the flows from Europe to the US into funds, not necessarily some, of course, into specific investments, but I think a lot of it is into funds that then turn into investment in innovative new firms.
I totally share your view. It's absolutely clear that the fact that we do not have a real single capital market is playing a very important role. But there are other elements, and I know, Yann, how keen you are to mention precisely the cost of failure in Europe, which is much higher than in the US. You had a chart on that.
Yeah, and I just want to clarify, it's not like Europe is lacking investment. It's just that firms invest in what we call marginal innovation, right, where you don't take that much risk. And they leave disruptive innovation to the US, right? Because again, they cannot stomach this kind of risk, but the risk is proportional to the return, right? So,
yeah, but if we are speaking of innovator in Europe that are absolutely remarkable, and would succeed in a US environment. The difference in Europe is that they don't get the capital. You have not the pool of capital, despite the fact that we are much more savings than the US. You do not have the capital, the risk capital, that it stands ready, of course, to have confidence. And even if, again, the innovation is fantastic and should normally be extraordinarily profitable.
I would say that the lack of profitability of large firms influences the lack of profitability of small firms, just because it's cascading. And who is buying smaller firms? It's larger companies. And those will take, when they merge, they'll take into account the cost of restructuring the two businesses, the big one, the small one, and they'll pay the small firm at a discount to take into account that cost.
Yeah.
So it's sort of cascading down.
Okay. Thank you. I'm sorry, Madame, you have the privilege of being the first lady to speak. It's very...
Which is an important privilege in this,
yeah, please.
in this day with so many panels with a feminine presence. Okay. No, it was just to go, maybe a question for Jeffry Frieden, because I think we should focus a little bit more about what is this real shift of paradigm to geoeconomics, and maybe we should focus more also to understand better the Chinese economic policy, and not only Chinese economic policy, but of many countries. And especially, to give an example, it seems to me, and this is my question, that geoeconomics, it's much more deeper than only the weaponization of economy. And it is, in my opinion, a sort of error to focus only on weaponization, because this is also another view, another vision, especially of resources, of scarcity of resources, and let's say a mercantilist spirit, which is spreading in many countries. And mercantilism, it means something which is much more deeper than protectionism, and it impacts public policies. It impacts also preferences of agents, meaning that the idea that resources are now a zero-sum game is impacting investment, the way to invest, the way to arbitrage for public policies in many countries. And it seems to me that geoeconomics is not studied deeply enough to understand what it means really. And it's not only weaponization, it's a new way to arbitrate, to make arbitrage, in economic policy. And we have a US economic policy which is based on mercantilism.
Okay, thank you very much indeed. You have to respond.
Sure, I guess I have to. Well, first of all, I think you yourself correctly have said this is not a new policy. This is mercantilism or neo-mercantilism. The most famous expression of mercantilism back in the 17th century was Thomas Hobbes, who said, wealth is power and power is wealth. And that's pretty much where we are today with this. I would not, by the way, say that this is necessarily simply an American term, although the United States is most prominent in its use of these economic tools. I said before that the West was united during the Cold War in using very, very extensive and much more extreme geoeconomic tools than are being used today. A nearly total prohibition on trade with the Soviet Union. And one of the reasons that was possible because there was general consensus that there was a goal, that the US and its allies had a goal in mind with respect to the Soviet Union. I think that, so let me say a few things about why I think this is happening. Part of it is economic competition. the sense that the Chinese have, and other countries, but China in particular, has used purposive government policy for both geopolitical and economic purposes, and that if other countries simply abide by liberal economic principles, they'll be left behind. So there's an economic competition component. There is a supply chain component driven both by the experience of the pandemic, in which countries found that they suddenly didn't have access to face masks or personal protective equipment because they were all made in China, and a broader sense that global value chains, that long and complex supply chains were making it difficult to figure out how countries could move forward in value-added terms without relying on countries that maybe they didn't feel were particularly reliable. And third, most broadly, the sense of vulnerability that the pandemic, the Russian invasion of full-scale invasion of Ukraine, trade wars, currency wars that all of these have given rise to. So I think this is an understandable set of defensive measures by governments who, after all, are charged with protecting their citizens from adverse effects. So I'm not happy about this turn, but I think that we have to, as you say, take it very seriously and think about what the implications are for the development of international economic and financial affairs.
Yes, and also
it seems to me, if I may,
may, just
please.
And also to integrate it into our economic tools and the way we are thinking about the open economy. Now, I mean, also, since we were speaking about solo and so on,
right.
It is now to be thought in a new paradigm.
And in the United States, at least, I am invited to at least 2 geoeconomics conferences every week. The National Bureau for Economic Research now has a program on geoeconomics, which meets spring, fall, and summer. So the work is being done. It's being done by academics, which may be a risk, but that is certainly being incorporated.
But in any case, you're in full agreement on one point. If I understood well your remark, this geoeconomics, to take your word, is both offensive and defensive. And what we experienced, all of us, as you said, with the pandemic, we realized to which extent it was very dangerous to have too long and stretched value-added chain at the global level. And that would necessarily ask us to hedge against the possible risk associated with the interruption of those chains. So I think we have to look at it from all possible angles.
Yes, and it changes also the behavior of agents. I mean, the only word which is common between macroeconomic text and geopolitics research, for example, if you take Gilpin's research, this is the preferences of agents. Preferences of agents are not the same today in a new paradigm also. It's not only economic policy level.
Okay, thank you very much. Do we have any other question? Yeah, please.
Yeah, thank you very much for this absolutely fantastic discussion. I wanted to ask the panelists about, on a more structural approach, how they, I would like to have their opinion about one of the main differences between the way Europe and the US fund their corporates. In the US, I may be wrong, probably around 70% of the funding of corporations comes from stock markets and equity, I mean, and it's and the rest for credit, and it's reversed for in Europe. In your opinion, does it have significant consequences on the issue of innovation that you highlighted? And if yes, in your view, can this structure, especially in Europe, change? And would, for instance, the unification of European markets have an influence on that very strong, very structural feature of the European financial markets?
Please, Yann.
Yeah, no, I'm often asked this question. I'll go back to the very simple distinction I made earlier, which is that we've had European champions forever. In fact, we invented capitalism, right? and we still have those champions, by the way, which were financed, as you said, more by banks than by markets, right? So they have a different capital structure, and yet their performance was very good. So meaning they could reward their shareholders the same way. So to me, the big difference is the risk level and speed of the tech industry that makes that older model just not viable in Europe, right? As simple as that. So now, of course, there are differences. It doesn't help that we don't have large pensions funds in Europe. Doesn't help we don't have a full single market. But I wouldn't say that's the first issue.
Please. Can I ask you on a question? Because this is a puzzle to me too. So you talk about the risk profile, but there are plenty of Europeans willing to lend in a kind of venture capital form to American firms. Why aren't they willing to lend to European firms?
Okay, well, let me give you a specific example. When Meta decided that they changed their name for nothing, that the metaverse was not going anywhere, that was at the end of 2022, at the same time ChatGPT appeared on the market. What did they do? They decided to make a complete U-turn and go full speed to AI. In the process, they ended up firing 20,000 people, 25% of their staff, right? Over a period of a few months, and at a cost equivalent to a few months of salary, right? Today, SAP, big German tech or auto companies announce plans over several years, right? So you cannot get the same kind of velocity as simple as that. So that's risk and agility, if you will, that is in question. We cannot have a Google or Meta in Europe right now. Meta announced just 2 days ago they were going to lay off about 10,000 people. I mean, you may argue, it's maybe excessive. They could have retrained their people, but they have the ability to act very quickly, very decisively. We just can't do that in Europe.
Yeah, but Yann, I'm sorry to interrupt, but you don't respond to the question which was asked.
Sorry, Jean-Michel.
Why do we maintain such different structure for the overall financing of the economy on both sides of the Atlantic? I am a little bit surprised myself, because I thought we would have some kind of convergence. On the one hand, clearly the market domination was terrible in terms of propagating the crisis, the last big financial crisis. So, and there was a lot of criticism of what had been done with the subprime and the rest of it. In Europe, we could see that we were very poor in terms of growing a market of a sufficient dimension. So the very naive idea that we will converge, we will draw all the consequences of the crisis and realize that there is something in between which could be better for the Europeans, better for the US. It's not at all what we have observed, clearly.
But Jean-Claude, very short answer. Back in 95, 30 years ago, productivity was roughly the same on both sides of the Atlantic. Yet the financing model was the same, right?
No.
What, the first...
Yeah.
30-70%. Yeah, right. So now, why is it so structural? I don't know. I would rather ask Jean-Claude as former central banker.
My sentiment is very clear. We are not at an optimum in Europe. That's my understanding. Whether or not the US goes too far in the other direction is something we should reflect upon. I don't think that on both sides of the Atlantic we are in any respect at an optimum personally. But, yeah. Nicolas and then Jeff.
Well, a couple of things. The reason why the European financial system is bank-based is because of European history and the roles that the banks have played in financing European governments, particularly in episodes of crisis and warfare. And the US has a completely different history of government funding that has always been more market-based for various reasons. And so you really have completely different historical paths. So I think we can, spend a lot of time about financial history, but basically the reason for the current difference between a bank-based Europe and market-based United States is essentially path dependency. Now the question is that optimal? I think there is a policy consensus in Europe to say it's not. That's why we have spent the last few decades talking about capital markets union, savings and investment union, and so on, which are basically this idea to rebalance the system and make it more market-based. So I don't think there is, and I don't want to spend time on why this is a good idea, but I think there is really a very broad consensus in European policy communities that this is the right thing to do. Now, why is it so difficult to implement? For two reasons mainly. First, the banks are not happy with it because it's a system, it's a concept of market development, and of course there's a lot of nuance because actually some banks are happy and other banks are happy for some segments, etc. But there is resistance, particularly the most obvious resistance is in Germany from the savings bank sector, which is very politically powerful and really doesn't like this idea of capital markets union, but there are other bits and pieces. And the other one is that governments don't like EU-wise integration because they lose sovereignty, and that's a discussion particularly about capital market supervision, which is the core of the current discussion about capital markets union. Now, let me say that on this, I am cautiously optimistic. I think we will get there. We will get to a single supervisor for markets, the same as has happened with banking and anti-money laundering and other things. 50 years from now, I'm actually quite confident that we will have progressed in the direction of a market-based system. But these things are very, very history dependent. They don't move quickly, and I think we should be realistic about what can be achieved by policy reform.
Before giving the floor to Gabriel, one remark. Could your hemisphere, which is dealing with the United States of America, tell us whether the system is optimal in the US, in your mind?
I think the system is actually quite good in the US. I think the US doesn't need to become more bank-based. I suspect they will become more bank-based because they're undermining trust in the US capital markets right now. The dismantling of market supervisory capacities, the rise of special deals, special treatments, insider trading by friends and family of the rulers, that kind of thing. No, I'm not making a joke. This is happening. It's documented in the media.
Okay.
And so I think they're undermining their market system, but to no advantage, neither to themselves nor to the world.
Thank you very much indeed. For the Europeans that do not necessarily know that there are in the United States of America two institutions. One is called Freddie Mae, the other is called Fannie Mae, I'm sorry, and the other, Freddie Mac. And these are more or less French type semi-public institutions that are taking a lot of risks to avoid the banks, to take the risk of the mortgages and so forth. So they are elements that we must have in mind when we compare the structure for Jean-Michel. So, Gabriel, you have the floor.
Yeah, thank you very much. I just wanted to add to what Nicolas said. An aspect that I think is important in Germany, certainly in parts of northern Italy, France too, Switzerland very much, Austria too. We have a lot of family-owned businesses, and family-owned businesses don't want to see their property be diluted on stock markets. So, and they, even today, we see that they finance a lot of their investments based on their own cash flow. They don't even go through banks. And that means that we have a cultural divide, no? And there's a whole equilibrium to be looked at. It's not just we have too many banks, if you like, but it is the demand for certain financial services, no, is very different given the family-owned capital bases in many of our companies. No?
Okay, thank you very much, Gabriel. Of course, this is true for Austria and very, very largely true for Europe as a whole. I have now several calls for the floor. Jean-Claude, then yourself, sir, and then you, Jeff? No. Jean-Claude, first.
Well, thank you. Just one word. We have not talked a lot about the bubble of IA. And this bubble, vis-à-vis also huge debts. And aren't we going to face a crisis, another crisis, not geopolitical this time, but an economic and financial crisis like the one we had with Internet in 2000?
Yeah.
Just a question.
Well, all those enormous construction, we were speaking of cement, are financed by the market. Certainly not by the corporate involved.
Yes.
And of course, you're absolutely right. At a time, we might have an explosion there. That's not totally impossible.
And especially if the rates increase.
Yeah. Please.
I'm sorry, I maybe going to raise something that was...
Do you have the mic?
Can you hear me?
Yes, much better.
I'm sorry, maybe I'm raising something that was discussed. I was late for the beginning of, so if it's the case, just tell me to shut up and I will stop. I wanted to talk about the non-banking market. A lot, particularly, and this is for the US market. As you know, historically, I mean, traditionally, the economy has been financed mostly by capital markets and to a lesser extent by banks in North America and the reverse in Europe. And I think that has changed, but not to a great extent. There's still a majority of lending in Europe that's done by banks and in the US by capital markets. Now recently what we've seen in the US is the development of the non-banking market. And that happens essentially, the shift was at the time of the great financial crisis of 2007 and 2009. And one of my concerns now is that effectively a lot of lending, I hope after been in banking for many years, particularly with American banks.
Could you speak closer?
No, I say I've been in banking for many years and worked for Citi, and I was involved in a lot of transactions. But after I left Citi, I moved to the private equity market. I deal in what I'm doing now, working for independent broker-dealer. We do a lot of lending, organizing lending by private equity firms. And as you know, there's also a very large sector of, particularly for middle market, but not just middle market, to lend to the economy in general, and certain sectors are no longer financed by the banking industry. My question is really looking at some of the development, and recently there's been some significant credit failure in the non-banking market. The question becomes, some of these institutions are, in my opinion, representing a systemic risk. And there's, as you know, in the United States, an organization that's, or a committee that's called the Financial Stability Oversight Council, which supervises the potentially of having systemic institutions. And this is chaired by the Secretary of the Treasury with participation from the Fed and from the SEC. The question that I have now is that if one of these institutions, non-banking, gets into trouble, is that something that's going to be viewed by being systemically important, and therefore would the regulator step up? And I'm thinking particularly in the context of the new chair of the Kevin Walsh, who's now, as you know, in the process of being confirmed as the replacement of Jay Powell. And the question is, what do you think, and what's going to be the likelihood of having a bailout?
Thank you very much. Very good question, of course. And I would say the crisis possibly coming from this kind of totally direct credit given by out of the banks is really a problem. But we have two U.S. citizens around this table, so maybe we could ask both.
But you're binational.
You prefer Nicolas? So
I'm not a U.S. citizen.
No, that's right. You're binational.
No, but Nicolas, if you think that you can enlighten us.
I think we have a number of different divides, and some of the conversation so far has kind of confused them to a certain extent. We have a divide between equity and debt. In debt, in credit, we have a divide between banking credit and market credit. And then in equity, and increasingly also in credit, we have a divide between so-called public assets in the sense of being tradable on the market, so typically between tradable stock and private equity, and increasingly also between bonds and private credit. These are not the same dualities. So I think we have to be somewhat rigorous in the way we talk about these different divides, and each of them has kind of a difference between Europe and the US. For example, in Europe, you have fewer publicly listed companies. You have also less bond financing. You have the housing market with Fannie and Freddie, which is a whole story within the story. And you also have less developed private credit market, which is a much more recent story, really, of the last few years in the US. Now, to the question of whether we should worry about private credit, if that was the question, yes, we should worry about private credit. I'm not sure how much we should worry about it, and here I would echo what John said about the tone of the spring meetings. It seems to me, but I will be a fool for having said that, that both crypto stablecoins and private credit at this point have been identified as potential systemic risk before they have grown to truly systemic size. Now, that doesn't mean this won't happen, but we also know that typically systemic financial crises happen from something that hadn't been identified as systemic risk. Actually, we're not talking about stablecoin here. We might. Stablecoin volume has flatlined over the last 6 months, which is kind of funny because this is exactly the moment when they became, the topic of every financial stability conference under the earth. I don't know if private credit is flatlining, but I think it's also a very, diverse segment in which you have a lot of good stuff, actually, like private equity. I think a lot of it is useful. But you also have supervisory arbitrage, especially with life insurance companies, and I think that's where the more fishy stuff happens. So basically, I'm calling for a lot of nuance, and on private credit specifically, I would insist on the fact that we know so little because the sector is so opaque.
I'm not sure that it is that opaque, because I don't want to pronounce any figure, but I have the memory of the start of this, and it goes much, much higher than the cryptocurrencies. I mean, in my memory. No? No? I'm sorry. John, you know better.
Well, what I wanted to say here is the source of systemic risk is hidden leverage. People have have credits that they don't understand that they've taken. That was the heart of the subprime crisis.
Yeah.
Was not the size of subprime loans themselves, that they were embedded in securities that were purchased. By the way, about half of the toxic subprime assets were purchased by European institutions.
Of course.
And
yeah.
so these institutions were the enablers of the crisis. So the question with private credit is not some could go broke. Well, of course some could go broke. The question is, are the people who hold the credit able to withstand the losses? And the risk is that institutions have lent money to intermediaries that have the credit, and so that the failure cascades backwards into some leveraged institution. So far, the judgment is that's not a risk on a scale that you would call systemic, even though for sure there will be losses. Similarly in AI, somebody's going to lose money, no question about it. But is it leveraged in a way that would cause systemic problems?
And I would add to that something that Dominique Senequier brought up yesterday, which is off-balance sheet vehicles that could have some hidden assets as well, and poorly financed and refinanced and
yeah. Please.
When Fidelity Investments came and tried to sell me private credits, I decided that we have now reached the European institution stage of the cycle. One observation while I have the floor, I was really struck by our discussion of AI and productivity that we never mentioned China. China is pursuing a policy of really trying to promote diffusion and China is leading the world in embedded AI in machines and robotics. And China China has one big advantage over the United States, which is that they've invested heavily in renewables, and so you have a electricity supply that is not likely to be as severe a constraint as in the U.S. Now in the U.S., if you want to build a data center, you basically have to build your own power source as well, because local electricity payers don't want to get socked with gigantic increases in rates to fund somebody's
yeah. Can I make the point that China was mentioned quite often here?
In the slides.
Yeah.
But not in the actual discussion.
Well, I mean,
it was a very Eurocentric.
No,
really. It's a very
certainly not Euro, certainly US-centric.
Yeah, US.
And transatlantic. But the importance of China is in all minds, and there is no doubt. And again, the problem of the European is that they see two giants on both sides of their continent, and this is not very reassuring. I remain a little bit struck by the fact that you are considering that private credit is not a real problem. Namely, certainly not a systemic problem.
Not systemic.
Yeah. Because of the size.
Yeah.
Yeah, please, Akinari.
Not just that, because major investors are insurance companies and private credit markets. So insurance companies are not leveraged, and what they incur losses, investment losses, what will happen? Policyholders, do they leave? That's a sort of question. If bank run sort of crisis, is it likely to happen? And IMF and FSB, they checked and they thought it's not like a bank run type incident.
The insurance companies don't have to mark to market.
Right.
So they can be very calm about these things.
They will absorb the losses easily. Is that's the idea. Yeah.
I wouldn't personally go as far as saying there is no systemic risk in private credit. I think we don't know, and again, the sector is very opaque. But I agree with John's characterization of what is the current, view in the community. I emphasize the opacity of the sector, even so. I don't think anybody has a full view of that market. So we're still in the discovery process.
Okay. So.
We didn't answer one question.
Yeah, please.
The council, the Financial Stability Council in the U.S. Does it function? Does it have any role?
So there is a lot of coordination between the Fed and the Treasury. In German, it might be called Gleichschaltung, that I'm projecting my own obsessions here. But especially on supervisory policy, there is a lot of evidence of political appointees being inserted in the Fed system, in a way, in an intermediate layer between Vice Chair Bowman and the staff, and a lot of meetings happening at the Treasury between the Fed and the Treasury to discuss financial stability and supervision. Is that good for financial stability? Time will tell. There's a possible other view, which is that actually it's bad because it undermines the supervisory independence of the Fed. Let me mention here that the independence of financial supervisors is a much less established concept than the independence of central bankers. And I think we're seeing a genuine divergence between the policy frameworks of the US and the EU, because in the US, the Fed, in its capacity as supervisor and regulator, is becoming increasingly aligned with the executive branch. And that's actually recognized by the Supreme Court, if I get the story correctly.
Yeah.
Conversely, in the EU, the supervision of banks microprudential supervision of banks has been placed under the ECB without any change in the treaty foundation of the ECB, and therefore supervision is as independent under the SSM as monetary policy is within the ECB. So the EU has reached an extraordinarily high level of supervisory independence in international comparison. There's a backlash against this right now. There is a lot of, there's a campaign, frankly, against the supervisory independence within the ECB, which is orchestrated, I think, by the banking sector, legitimately as defense of special interest. And I don't know how it will play out, but I will note that to change that, you need to change the so-called SSM regulation of 2013, which is adopted by unanimity. Yeah. And therefore, I think it will be very interesting to observe how this debate about supervisory independence evolves in the next few years. Note that this is not about regulation, because the ECB is not a regulator, it doesn't set rules, it's only about the enforcement of the applicable rules with the element of discretion that is inherent in banking supervision. Thank you.
Thank you very much indeed. What you say is absolutely right. And of course, it was possible because in the Maastricht Treaty, it was already foreseen that if there was unanimity, in particular on giving the central bank this responsibility, it was possible. So we didn't have to negotiate any new treaty for a change which was really extraordinary and came after the crisis, only because it was clear that the system had not functioned very well, and taking into account the fact that two different traditions were colliding. There was a tradition of full independence out of the central bank of the surveillance authority, another tradition that it was in the central bank. And by the way, the IMF made a lot of global campaign at a time for the FSA type, the Financial Stability Authority type, like the UK. And after the crisis, the trend was not reversed. We had a new pendulum, if I may, a caricature of pendulum. So thank you very much, Nicolas. So we do not respond as well as you would have hoped to your question. I would say that there is undoubtedly a problem with the very rapid growth of this private credit, and there has been some problems here and there. Now, the qualification of the phenomenon as being systemic, we will see, and perhaps it's not yet time to say that.
Can I have a follow-up comment?
Please, of course.
No. One of the gentlemen said that part of the private market is insurance companies. I mean, in the case of the Financial Stability Oversight Council that I made reference to, a few years ago, they considered that MetLife, which is an insurance company, life insurance company in the US, was a systemic risk. So, I mean, this is not something that's reserved for banking industry or quasi-banking industry. Yeah. But I mean, at the moment, the landing in the Nicolas is right in the sense that there is some opacity, there is no statistic, because this is non-regulated sector. And this is my point. This is the reason why I'm asking the question. We're talking of a non-regulated sector as such. You know, insurance companies are regulated in the US by a special supervisor for insurance companies.
Yes,
there is no joint supervision, which is another problem. We separate the supervision of insurance company, which is done at the state level. And as you know, the systemically important banks are overseen by the OCC or by the Fed at the federal level. So this is really one difference that makes, that's why the question of if there is a problem that becomes systemic, will the regulator bail out the institution? In my sense, it will be very difficult.
Yeah, of course it would be very difficult.
Bail out a non-banking institution. But we had, during the financial crisis of 2008, AIG was bailed out effectively. So we have precedent.
Yeah. But AIG was an insurance company which was supposed to be controlled and surveyed, and so.
But you know, they were trading in CDS.
Yeah, no, I remember.
In London.
I remember.
And there's an issue, as John was saying, of consolidation. You know,
yeah.
That was not necessarily viewed as being, and that was supervised by an insurance supervisor.
Yeah, sure, but supervision was very poor, and we had the crisis only because we made a lot of mistakes, obviously, in all countries, including in the US, of course. So that being said, it is 6:20. I had said that perhaps we could exchange views on the cryptocurrencies, the stable coins, and so forth. Again, there, the action is in the US in many respects. So if I turn to our US friends, can I ask you how you see things? You know that in Europe, the stable coin, which I understand are stabilizing, but which had an episode of extremely rapid outstanding growth, were considered as a very astute mean to finance the US Treasury indirectly through the so-called, I would say, bills and bonds that would back, of course, the stable currency. So how you see that? Was the fear of the European exaggerated? Where do we stand?
We'll see. We'll see. The problem, I think I described it in the panel yesterday. When you have really four options, principal options. On the one hand, crypto, which has no backing and trades on an open ledger. You have stable coins that have backing and trade on an open ledger. You have tokens, tokenized deposits that have backing and trade on closed ledgers, and you have central bank digital currencies that are a form of money. If we go to crypto, the limitations are obvious. And if you ask what's the use case, essentially it's for illicit transactions or someone, if you want to hide assets, clearly seemingly within limits and subject to extreme volatility. The idea of the stable coin was to provide, as I say, promoted by folks who, on the one hand, if you can say, what is the use case for stable coins? In the US, for why would a US citizen hold a dollar stable coin when you could hold a dollar? It's for cross-border transactions, and my understanding is the actual stable coins have been used substantially as on and off ramps to crypto. And the idea was to provide some kind of a regulatory, the Genius Act was designed to provide some regulatory credibility to these instruments, and the attraction to the government of why they wanted to promote that was, as you say, the notion that they would be useful internationally as a store of value and as a means of transactions backed by U.S. Treasury securities. So it was viewed as a way to do that. My own view is that there's the weakness of the stable coin is it's what I call story money. If you said, here's a stable coin, it's worth $1, you'd want to know, wait a minute, who's issued it? What are the reserves? How is it governed? What are the terms? You'd want to hear the story. Tokenized bank deposits strike me as another digital asset that could be very attractive, in as much as if the bank is credible, it's on their balance sheet. It can be traded 24/7, real-time settlement. It can be converted into your local currencies. That strikes me as an asset that could have real attraction internationally, and I think that worries a lot of national authorities, that could end up diminishing their monetary sovereignty.
Mm-hmm.
Would it in the end have an impact on the holding of treasury securities? I think that's more ambiguous, potentially. But I think
not necessarily, because I understand that the deposit itself would be the guarantor, the guarantee.
Yes, exactly right.
And John, just to be clear, so you would compete basically with joint, say, MasterCard networks, you would compete with wire transfers and make all these things sort of commission-free, in effect, right?
Exactly.
Yeah.
And it could serve as a store of value.
Well, I think that's part of the issue. I think there's a debate, as I understand it, as to whether stablecoins are simply another form of fast payment system.
Yeah.
They're very widely used by immigrants in the U.S. for remittances, because it's a very convenient way to not pay 20% commissions to send money back to Guatemala, right? But that's a fast payment system. That's not a store of value. And I think the underlying question is whether they could serve as a store of value. And I think that has to do with what happens with stablecoins. I mean, at this point, there's a question about paying interests when it's not clear what the underlying asset is that's paying the interest, and whether it's actually backed by interest-bearing assets, and whether people would trust them. Right? The issuer can say we're paying 4% because we own 100% 4% treasuries, when they might not. So whether they can serve as a store of value, I think is still an open question.
Okay, and what do you think of the central bank digital currency?
For me, I have a hard time understanding the use case. If it's a retail, it's offered at retail, it just would disintermediate the banking system. If it's offered at wholesale, you said, what's the point? I don't quite get it.
No, I guess that the idea is to take advantage of the technology, and which is not necessarily the case, if I understand well, with the traditional way of organizing the wholesale. No?
Yes.
Yes, but.
Yes, but. The Fed has a Fed Now.
Yeah.
Nobody uses it.
Uh-huh.
It's not clear that there's huge...
There is no advantage. Okay. As regards the retail, I fully share your view, of course. And on top of that, we have also all the problems of the control of financing of terrorism, criminal activities, and that's an enormous problem.
It's also geopolitics. So many central banks issue. It's also linked with geopolitics. I mean, the Chinese again. I mean, they are all over the world.
Yeah, it's true. It's true that the central banks, apart from the United States central bank, which is perhaps told don't engage in that direction, but many other central banks have, and including of course the ECB, are envisaging to have this kind of. Whether or not it would prove very useful, we will see. In any case, it's a way for them to demonstrate that they can also manipulate the new technologies, which is part of the benefit. But I'm sorry, Gabriel had asked for the floor. No? I'm sorry, Gabriel. So please,
just wanted to say, of course, the CBOC already has a digital yuan that's very little used.
Yeah.
And I suspect there may be privacy issues at the heart of that.
So
you may not want.
Yeah, please.
Yeah, no, if I can ask, it's really a question about financial stability. So in your list of 4 candidates, really only stablecoin is a good one, right? If I understand you correctly, potentially. Out of the 4 that you listed, only stablecoins are sort of.
Well, no, I think tokenized bank
Tokenized
going to be the winner.
Deposit. Yeah, sure. Yeah, but, please.
But just to.
I'm sorry.
No, the question was.
The question is.
No, just one comment about EU1. If I understand correctly, EU1 didn't fly much because two things. One is maybe privacy issue matters, but more important is Alipay's, WeChat Pay already there. Every Chinese use comfortably in all the systems. So it was very difficult for central bank to introduce new,
exactly what you said.
Payment system. This is one thing.
Yeah.
Secondly, several months ago, PBOC decided to let commercial banks take care of E-yuan. So E-yuan is now the product of deposit instruments of commercial banks in China rather than central bank's money. So the status has changed.
Let me ask you, why are European large banks pushing for issuing stable coins?
No, they don't.
No, I don't know.
They don't at all. No.
They resist it. They're the ones that don't want it.
Yeah.
They don't issue them, they don't want them.
No. Yann, please.
Yeah, no, I never asked my question about liquidity. John, do you think any of this new form of payments could have helped during the liquidity crisis of 2008 somehow, where it was hard sometimes to.
Well, the heart of the crisis was the freezing of the interbank market.
Right.
That was the key.
Right.
I don't see that this.
Because you bypass the interbank system in a way.
Oh, you mean if it had
been in place?
Potentially, yes.
Interesting, right?
Yeah.
But
in other words, if we had a different system, it wouldn't have had the same problem.
Yeah, exactly. But the main
I was hoping the problem would have been reduced.
The main problem was that we did not have absolute confidence in the signature of the other partners, and that we experienced that in an exemplary way in Europe on the 9th of August 2007, where we were bound to take an extraordinary decision to tell all banks after 2 hours and a half of meditation at the level of the ECB, of the executive board, we said we will give you all the money that you would like to get. And we thought that it would be around 30 billion, 35 billion. They asked us 95 billion euros. So it was absolutely gigantic. And of course we appeased them, but the market was not functioning at all. It was total interruption of the functioning of the market. But
I may be wrong, but Lorenzo Binismaghi, he wrote a piece, it's quite a while ago, and said, we in Europe, we should go for stable coins, euro-based stable coins, and other European banks, large banks. If we don't do it, American banks will do it. It's real.
No.
So if I can interject here, because Lorenzo Binismaghi, of course, is the chairman of Société Générale, and Société Générale still is 40 days, I think.
Yeah,
I think the handover is in 1 or 2 weeks. The Société Générale has launched a euro-denominated stablecoin product, which has not been very successful commercially so far as I know. It's an outlier among European banks. It's a bit experimental. I'm not aware of other large European banks that have done that already. There are a number of projects going on. I think what the banks have clearly opposed is not euro-denominated stablecoins, is the digital euro, the central bank digital currency. The banks dislike the digital euro because it will potentially disintermediate a number of rents from which the banks are making a lot of money. But that's not about stablecoin, it's about the CBDC project.
Yeah, absolutely clear. Absolutely clear. Okay, so we don't have any new comments or questions or remarks on the cryptocurrencies or crypto tokens or whatever? No? Can I consider that we had very good exchange of views and we learned a lot? Thank you very, very much indeed.
Yeah, I received the email from the secretary.
Ladies,